Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down LVMH, the world's largest luxury group, home to Louis Vuitton, Dior, MOAT Tennessee, Tiffany & Co, and dozens of other powerhouse brands. From fashion to fine wine, LVMH has built an empire of prestige. But how does the stock stack up today based on the fundamentals? We're going to break down LVMH's stock using our 5 key factors to determine whether it's undervalued, fairly valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, be sure to like and subscribe. Now let's dive in. Let's start by asking, is LVMH turning its investments into real value? LVMH's return on invested capital is 11.6% and its return on equity is a strong 19%. That shows LVMH remains a well-managed business, though returns have dipped slightly in 2024. CFO Jean-Jacques Guillaume attributed this to minimal price increases last year, making it tougher to absorb rising costs. Even CEO Bernard Arnault noted the group is being cautious with price hikes to protect long-term customer relationships. Still, one of LVMH's key strengths is its fully integrated model, controlling everything from production to retail. That's helped it maintain strong margins and stay ahead of the pack. Next, let's look at whether LVMH is delivering the kind of growth that can power strong long-term returns. Over the last decade, revenue grew at a compounded annual growth rate of 10.1%. Net income grew at a CAGR of 15%. Earnings per share grew at a 15.1% CAGR, hitting 25.1 euros in 2024. However, earnings per share declined last year, reflecting softer luxury demand in key markets like the US and China. Looking forward, analysts expect muted growth through 2027, citing global economic uncertainty and slower consumer spending. That said, luxury tends to be more resilient. High margins, strong brand equity, and pricing power help companies like LVMH weather economic pressures, including potential tariff risks. Proposed US tariffs could add 20% on European luxury goods and up to 31% on Swiss watches. But firms like LVMH are often better positioned to absorb or adapt to these kinds of pressures. Strong growth is only sustainable with a solid balance sheet. As of 2024, LVMH holds 13.6 billion euros in cash and 41.3 billion euros in debt. That may look like a lot, but let's put it in context. A key metric here is the debt-to-equity ratio. For a business like LVMH, a ratio below 1 is generally seen as financially sound. Today, LVMH sits at 0.6, down from 1 in 2020, a clear sign of improving leverage and disciplined capital management. And don't forget, this is the same company that pulled off the $16.2 billion acquisition of Tiffany & Co in 2021, without compromising balance sheet strength. Even great companies can make poor investments if you overpay. So how is LVMH's stock valued today? LVMH currently trades at a price-to-earnings ratio of 19.4, which is lower than many of its luxury peers like Burberry, Richemont, and Hermès. That suggests it's priced reasonably relative to earnings. A helpful check here is the PEG ratio. That's the price-to-earnings ratio divided by earnings growth. It helps us see whether the valuation makes sense based on expected growth. In LVMH's case, the PEG points to a valuation that aligns with its historical performance. But the key question is whether that growth continues. With slower growth expectations through 2027, the stock looks fairly valued for now. Not screamingly cheap, but not overpriced either. Lastly, let's assess whether LVMH has a moat that can protect its profits for years to come. LVMH's competitive edge is all about brand power, control, and scale. From Louis Vuitton to Dom Pérignon It owns some of the most valuable names in luxury. Combine that with vertical integration, owning production, logistics and retail, and you get a business that's hard to disrupt. But the luxury world is changing. New brands, shifting consumer values, and the rise of digital-first players are real threats. LVMH is responding by investing in exclusivity, sustainability, and innovation. But staying on top will take constant reinvention. Before we wrap up, you might have noticed the clean, detailed charts in this video. They're powered by FinChat. If you want to upgrade your investment research, check out the link in the description for a 15% discount on FinChat's premium tools. In my view, LVMH's stock is fairly valued based on our 5 key factors. LVMH delivers decent returns on capital with a 19% return on equity, showing financial efficiency. Earnings per share grew at a compounded annual growth rate of 15.1% over the last decade, which is impressive. LVMH has healthy levels of leverage with a debt-to-equity ratio of 0.6. A price-to-earnings ratio of 19.4 compared to its growth makes it fairly valued. LVMH has a strong moat through its iconic portfolio of brands and direct control over production and distribution. However, emerging brands, shifts in consumer values, and digital disruption all pose challenges. What's your take on LVMH? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.